good morning. Welcome back to the show. It's 6:33 as we get this Tuesday underway. I said earlier, markets are pointing higher this morning. Not really any news out to speak of. Just really it's kind of the first day of the month. And as first days of the month typically go, particularly as we had a little bit of a sell-off yesterday. Not big. Had a little bit of a sell-off in stocks yesterday. Kind of the bigger sectors hit yesterday were the international markets because of the big jump in the dollar. So you had a big jump in the dollar yesterday that impacted emerging markets, international markets as well. Weighed on commodity stocks. Energy stocks were down sharply. You see you get a little bit of a reversal today. Again, just as mutual funds and pension funds, those type of things, they typically take on bets right at the first of the month, depending on what their outlook is. But that really doesn't negate the fact that we've got a lot of rebalancing to do over the course of this month. After a big gain like we had last month, mutual funds need to rebalance. And also we've got distributions coming up. It's the end of the year. So we've got distributions coming up. Pension funds, again, they have to rebalance. Mutual funds have to make distributions and rebalance. So, there's, despite the fact that today's going to open up strong, it's going to be a question of whether or not we can maintain it throughout the day. Is one thing. We've seen these kind of openings before where the market opens up like 1%, and we sell off most of the day. Not saying that's going to happen, but we've seen these days before. But it also doesn't mean that today's gain can't be reversed over the course of the next few days. But again, nonetheless, markets are going to open up stronger today, which is good news. And this is where you have some opportunity here. And as we've been talking about, really kind of when you look at the markets, and again, if you in our technically speaking post today, we've got 3 charts in there in particular, which are looking at deviations from long-term means. So, for instance, if you take a look at a daily chart of the S&P 500 right now, it's trading nearly 15% above its 225-day moving average. So that's basically its 1-year daily moving average of trading. And so when you start thinking about that and looking at that deviation, you're 15% above, that's a level that, has only happened a few times historically going, all the way back to 1960. And when you get these types of deviations, it doesn't mean you get an immediate correction, right? It doesn't mean you immediately, oh my gosh, we're going to have a 2009 crash. But it has typically aligned with at least short-term peaks in the markets. In fact, the last time that we were this extended was in September, and we had a 10% correction, right? Same thing goes with the weekly, right? So if we look at a 1-year moving average on a weekly basis, right, 52 weeks, the market currently is running just slightly below a 15% deviation above that 1-year moving average. Now, again, this is essentially what's happening in the markets. To put this in simplistic terms, is you're trying to stretch something as far as it can go in one direction. So think about a spring or a rubber band, whatever it is, and you pull it as far as you can in one direction. Well, it's got to relax before you can stretch it again, right? And there's a point to where you stretch it and ultimately it breaks, right? So you can only stretch something so far. And that's really the way moving averages work within the markets. They're kind of the gravity. So when you stretch something, when you stretch price as far as you can above those moving averages, that gravitational pull, that desire to come back to that moving average increases. And the reason it's an average, remember, the reason you have an average is that prices have to trade above and below that average over a period of time. Back in February of this year, we were warning about a potential correction in the markets. And there was really no worry here. We weren't worried about a pandemic in February. And we wrote an article talking about why we were taking profits. Markets were too overly extended. And we were about at this same level back in February of this year. And we corrected not only back to that moving average, but well below it. Now, that doesn't always happen. You don't have that type of extreme contraction. It does occur historically, but not that often. But generally, when you get very, very far extended above these long-term moving averages, you get at least a correction back to the moving average, if not slightly below it, right? And that's why moving averages are rising over time. because you're slowly bringing that average up because you're not correcting always below it. But you do consistently throughout history come back and retest those averages. Same thing on a monthly basis. Right now, you've got a monthly extension that is currently about 17.5% above the 2-year monthly moving average. Very long-term moving average here, right? This is an extension point that you rarely see. Last time you saw this was in January of 2018, and we had about a 20% correction. So what I'm telling you is I'm not trying to scare you. I'm not trying to be bearish. I'm not telling you go cash out everything and go hide in gold and silver, right? I'm not saying that at all. All I'm saying is that there's a lot of good news, as we were talking about it in the last segment. Pretty much whatever you look at in the markets, right? Whether it's, recovering earnings or recovering economic data, more stimulus, whatever it is that is your particular news du jour, that is your support, your rationalization for current prices, that's priced in. You've stretched that rubber band as far as you can. So the point here is that if there's something that comes in that is disappointing, right? We don't quite make those earnings numbers. We don't get the amount of stimulus that we're expecting, right? Maybe we get stimulus, but it's only 500 billion, not 3 trillion, right? There's lots of room for disappointment. And when you have that room for disappointment, that's how you get a correction in the markets. And that's why, when you look at any great historical money manager or trader, right, throughout history, they have some very simple rules. And one of those rules is always, buy low, sell high. Problem is we always forget the sell high part, right? So we do a pretty good job of buying. Most people do a good job of buying. Problem is they forget to sell. And you're not always going to get it right. I mean, the beautiful thing about investing is that you don't have to always be right. You can be a very successful investor and only be right 70% of the time. You're not going to get every trade right. And that's the important thing here, right? Not every trade is going to work out exactly like you plan it to work. And that's okay. But that's why you have stop losses. That's why you have rules around managing your portfolio to limit the capital destruction if something doesn't work out the way that you expect it to work out. But that's the point of investing, right? We have to have these rules. The problem for most people is that when markets are going up, it's great. It's fun. It's exciting. It's exuberant, right? I mean, I'm just, I love looking at my portfolio every day because the markets are going up. What we don't like is when it goes in the other direction and we haven't taken any actions to protect that downside. So we wind up potentially giving up a lot of our gains. Again, look, sometimes that's going to happen, right? Just when you're managing your own money, even when somebody else is managing your money, mistakes are going to happen. That's just part of the game. And you have to understand what the rules of the game are. And this is, we write a lot of articles about rules. In fact, we just posted just recently in last weekend's newsletter on our website, 7 impossible trading rules. The reason they're impossible trading rules is because our psychology keeps us from actually trading as we should and investing as we should. And don't construe trading and investing as two separate things because they're not. Whenever you invest, you're trading, you're buying something. Right. And what Wall Street wants you to do is they tell you, well, just buy it and hold it, and never sell it. Right. They're good for Wall Street, not so good for you in a lot of cases. We're all ultimately speculators. We have no control over what companies do. Warren Buffett's an investor. Right. He buys whole companies. And, as I said before, when Warren Buffett invests in a company, he goes into the boardroom and says, OK, you at the head of the table, that's my chair. And he runs the companies, right? Or he appoints people to run those companies that work for Berkshire Hathaway. That's investing, right? Because he has the ability to adopt strategies and make changes to these companies and the way they behave to make them more profitable. He has the ability to combine a company with another company that he owns to make them more profitable. He has tactical advantages. You don't. All you do, and all I do, right? We're all the same. All we do is buy pieces of paper at one price and we hope to sell them at another. That's the best we can hope for. That's all we can do. And we have to maximize that opportunity as much as we can. And we're not always going to be right. Even Warren Buffett makes mistakes, right? Warren Buffett owned a bunch of airlines. Didn't plan on the pandemic, but, happens, right? So he sold a lot of those investments. Everybody makes mistakes. Even the great Warren Buffett makes mistakes. But that's part of the game. And if you're not willing to accept those mistakes and make those mistakes, A, you're not ever going to build wealth. And two, you're deluding yourself ultimately to the point that you're going to wind up hurting yourself more than anything else. Understand you're going to make mistakes, but have a strategy and a discipline to deal with it. And that's why we post these rules out regularly. But this is that point in time where exuberance and excitement and bullishness start to cloud our better judgment about managing the risk in our portfolios and saying, man, I should really, when you hear that little voice saying, man, I should really sell a little bit of this. That's your subconscious going, you should really sell a little bit of this. Don't let the other part of your conscious tell you not to. Be right back after the break.
You're listening to The Real Investment Show